Understanding gold futures, your first step into precious metals. Gold has always held a special allure for humanity. For thousands of years it has been a symbol of wealth, power, and stability. This precious metal is not just used in jewelry or industry. Many people invest in gold because they see it as a safe place to store their money. It often holds its value when other investments, like stocks, might fall. During times of economic uncertainty or rising inflation, investors frequently turn to gold. They believe it can protect their purchasing power and offer security when markets are volatile. This timeless appeal makes gold a unique asset in the financial world. Futures contracts are a type of financial agreement. They are standardized contracts traded on an exchange. When you buy or sell a futures contract, you agree to transact an asset at a predetermined price on a specific date in the future. These contracts are common for commodities like oil, agricultural products, and, of course, precious metals like gold. The key elements are the asset, the quantity, the price, and the delivery date, all fixed up front. This standardization makes futures contracts easy to trade and understand for market participants globally, providing a transparent and regulated trading environment for various underlying assets. So what exactly are gold futures? They are futures contracts where the underlying asset is gold. When you trade gold futures, you are agreeing to buy or sell a specific amount of gold, usually 100 troy ounces, at a set price on a future date. Importantly, most traders in gold futures do not intend to take physical delivery of the gold. Instead, they aim to profit from changes in the gold price. Trading gold futures involves leverage. This means you only need to put up a small percentage of the contract's total value, known as margin, to control a large amount of gold, amplifying potential profits and losses. Trading gold futures offers several advantages for different types of market participants. Speculators can use gold futures to bet on the direction of gold prices. If they believe gold prices will rise, they can buy futures contracts. If they think prices will fall, they can sell them. Businesses that use gold, such as jewelers or electronics manufacturers, can use gold futures to hedge against price fluctuations. This helps them lock in a price for gold they will need in the future. Gold futures markets are also very liquid. This means there are many buyers and sellers, making it easy to enter and exit trades quickly at competitive prices. The power of charts. Why technical analysis is key for gold futures. Technical analysis is a method used to evaluate investments and identify trading opportunities. It relies on analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which looks at a company's financial health or economic factors, technical analysis focuses purely on market action. Technicians believe that all known information is already reflected in the price of an asset. Therefore, by studying price charts and various indicators, they aim to predict where prices might go next. This approach can be applied to any asset with historical trading data, including gold futures. Gold prices are known to be influenced by a wide range of factors. These include global economic conditions, inflation rates, interest rate expectations, geopolitical tensions, and currency movements, particularly the US dollar. While fundamental analysis tries to weigh these factors, technical analysis offers a different lens. It assumes that the collective actions of all market participants, their hopes, fears, and expectations, are all captured in the price movements on a chart. For gold, which often trades on sentiment and as a safe haven asset, technical analysis can be particularly insightful. It helps traders decipher the market's psychology and identify patterns that may repeat. There are three core assumptions that underpin the philosophy of technical analysis. The first is that market action discounts everything. This means all relevant information, whether it's economic news, political events, or market sentiment, is already factored into the price of gold. The second assumption is that prices move in trends. Technicians believe that once a trend is established, whether up, down, or sideways, it is likely to continue for some time. The third assumption is that history tends to repeat itself. Market patterns driven by human psychology often recur over time, providing clues for future price behavior. These principles are widely applied by gold traders. Using technical analysis for trading gold futures brings several practical benefits. It can provide traders with objective signals for when to buy or sell, helping to remove emotion from trading decisions. Technical indicators and chart patterns can also help in identifying potential price targets and setting stop-loss orders to manage risk effectively. Furthermore, Technical analysis can be adapted to various trading styles and time frames, from short-term day trading to longer-term position trading. Its principles are relatively straightforward to learn, making it accessible even for those who are new to the complexities of the gold market or futures trading in general. Reading the market's mind essential chart types and patterns. Price charts are the primary tool for any technical analyst. They provide a visual history of an asset's price movements over a specific period. Think of a chart as a map of the market's past behavior. By studying this map, traders try to identify patterns, trends, and potential turning points. This information is crucial for making informed trading decisions in the gold futures market. There are several types of price charts, each offering a different perspective on the price action. Understanding these charts is the very first step in applying technical analysis effectively to your gold trading strategy. The simplest type of price chart is the line chart. It is created by connecting a series of closing prices over a given time period. For example, a daily line chart for gold would connect the closing price of gold for each trading day. Line charts are very easy to read and understand. They are particularly useful for identifying long-term trends and getting a quick overview of the price direction. While they don't provide as much detail as other chart types, their simplicity can be an advantage in filtering out market noise and focusing on the bigger picture of gold's price trajectory. A more informative chart type is the bar chart, also known as an OHLC chart. Each bar on this chart represents a specific time period, like a day or an hour, and shows four key pieces of price information: the opening price, the highest price, the lowest price, and the closing price for that period. The top of the vertical line indicates the highest price, and the bottom indicates the lowest price. A small horizontal tick on the left side of the bar shows the opening price, and a small tick on the right side shows the closing price. Bar charts provide a good sense of price volatility and range. Perhaps the most popular chart type among traders today is the candlestick chart. Originating from Japan, candlestick charts display the same OHLC information as bar charts, but in a more visually intuitive way. Each candlestick has a body and wicks, or shadows. The body represents the range between the opening and closing prices. If the close is above the open, the body is often colored green or white, indicating bullish sentiment. If the close is below the open, it's colored red or black, indicating bearish sentiment. The wicks show the high and low prices. Candlestick patterns can offer powerful insights into market sentiment and potential reversals in gold prices. Smoothing the path, mastering moving averages for gold trends. Moving averages are one of the most widely used technical indicators in trading, including for gold futures. A moving average calculates the average price of an asset over a specified number of periods. For example, a 20-day moving average shows the average closing price of gold over the last 20 trading days. Its main purpose is to smooth out short-term price fluctuations and highlight the underlying trend direction. Because they are based on past prices, moving averages are considered lagging indicators. This means they confirm a trend after it has started, rather than predicting it in advance. There are different types of moving averages, but two are particularly common: the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average gives equal weight to all prices in its calculation period. For instance, in a 50-day SMA, each of the past 50 closing prices contributes equally to the average. SMAs are straightforward to calculate and understand. Common SMA periods used by gold traders include the 20-day for short-term trends, the 50-day for medium-term trends, and the 200-day for long-term trends. These longer-term MAs often act as significant support or resistance levels. The exponential moving average works slightly differently. It gives more weight to the most recent prices in its calculation. This makes the EMA more responsive to new price information compared to the SMA. As a result, EMAs tend to react more quickly to price changes and turn sooner when a trend is reversing. Some short-term gold traders prefer EMAs for this reason, as they can provide earlier signals. However, this increased sensitivity can also lead to more false signals, especially in choppy or sideways markets. The choice between SMA and EMA often depends on the trader's style and preference. Moving averages are versatile tools for gold traders. Their primary use is to identify the direction of the prevailing trend. If the gold price is consistently trading above its moving average, and the moving average itself is sloping upwards, it suggests an uptrend. Conversely, if the price is below a downward sloping moving average, it indicates a downtrend. MAS can also act as dynamic support levels in an uptrend and dynamic resistance levels in a downtrend. Furthermore, the interaction between different moving averages, such as crossovers, can be used to generate specific buy or sell signals, which we will explore later. Alright, let's dive into Section 5, Gauging Momentum. We're going to talk about the Relative Strength Index, or RSI, in gold trading. So, momentum in trading, it refers to the speed or velocity of price changes in an asset like gold. And understanding momentum it's pretty important because strong price moves are often accompanied by strong momentum. On the flip side, weakening momentum can signal that a trend is losing steam and might be due for a correction or even a reversal. Now, the Relative Strength Index, or RSI, is a very popular momentum oscillator. It was developed by J. Wells Wilder Jr. and is designed to measure the speed and change of price movements. This helps traders identify potential overbought or oversold conditions in the gold market. The RSI is calculated based on the average gains and average losses over a specific look-back period, typically 14 periods, whether that's days, hours, or what have you. The indicator oscillates between 0 and 100. It quantifies the internal strength of the market by comparing the magnitude of recent gains to recent losses. A rising RSI suggests that bullish momentum is increasing, while a falling RSI indicates that bearish momentum is strengthening. Traders watch the RSI level to gauge whether gold's price action is becoming too extended in one direction. This can potentially signal an upcoming pause or pullback in the current trend. Traditionally, RSI values above 70 are considered to indicate an overbought condition for gold. This means gold prices may have risen too far, too fast, and could be due for a pullback or consolidation. Conversely, RSI values below 30 are typically interpreted as an oversold condition. This suggests that gold prices may have fallen too much and could be poised for a rebound. However, it's crucial to exercise caution. In strong trends, gold can remain overbought or oversold for extended periods. So these levels should not be used as standalone buy or sell signals without further confirmation. A more powerful way to use the RSI is by looking for divergences. A bullish divergence occurs when the price of gold makes a new low, but the RSI makes a higher low. This suggests that the downward momentum is weakening, and a potential upward reversal might be approaching. Conversely, a bearish divergence happens when gold's price reaches a new high, but the RSI forms a lower high. This indicates that the upward momentum is fading, and a downward correction could be imminent. Divergences often provide more reliable signals than simple overbought or oversold readings, especially when confirmed by other technical factors. In Section 6, we delve into trend and momentum together by unpacking the MACD indicator. The Moving Average Convergence Divergence, or MACD, pronounced MACD, is another highly popular technical indicator. It was developed by Gerald Appel in the late 1970s. The MACD is a trend-following momentum indicator that shows the relationship between two exponential moving averages, or EMAs, of an asset's price, such as gold. It's designed to reveal changes in the strength, direction, momentum, and duration of a trend. Because it combines elements of both trend and momentum, many traders find it particularly useful for analyzing gold price movements and generating trading signals. The MACD indicator consists of three main components, which are typically plotted below the price chart. The first is the MACD line itself. This is calculated by subtracting a longer-term EMA, usually 26 periods, from a shorter-term EMA, usually 12 periods. The second component is the signal line, which is typically a 9-period EMA of the MACD line. The third component is the MACD histogram. The histogram represents the difference between the MACD line and the signal line. It visually shows when the MACD line is pulling away from or converging towards the signal line, indicating strengthening or weakening momentum. One of the primary ways traders use the MACD is through crossovers. A bullish crossover occurs when the MACD line crosses above the signal line. This is often interpreted as a buy signal, suggesting that upward momentum is increasing and a new uptrend might be starting, or an existing one resuming for gold. Conversely, a bearish crossover happens when the MACD line crosses below the signal line. This is generally seen as a sell signal, indicating that downward momentum is building and a downtrend could be underway. These crossover signals are widely watched by gold traders Beyond simple crossovers, the MACD can also provide signals through divergence and its histogram. Similar to the RSI, MACD divergence occurs when the price of gold makes new highs or lows, but the MACD indicator fails to confirm these extremes, signaling potential trend weakness. The histogram is also insightful. When it is above the zero line and growing, bullish momentum is strong. When it is below zero and falling, bearish momentum is dominant. Crossovers of the MACD line above or below the zero line itself are also considered significant, indicating a shift from bearish to bullish momentum or vice versa. In Section 7, we explore Practical Strategy 1, Riding Gold Waves with Moving Average Crossovers. A moving average crossover strategy is a classic technical trading approach that is relatively simple to understand and implement. Even for beginners trading gold futures, the core idea is to use two moving averages of different lengths, one short-term and one long-term plotted on the gold price chart. A trading signal is generated when these two moving averages cross each other. This strategy aims to capture profits from new trends as they emerge. It is based on the principle that a shorter-term average reacting more quickly to price changes will cross a slower, longer-term average as a new trend begins. A common bullish signal in this strategy is known as the golden cross. This occurs when the shorter-term moving average crosses above the longer-term moving average. For example, many traders watch for the 50-day simple moving average to cross above the 200-day SMA on the daily gold chart. Such a crossover is often interpreted as a strong signal that a new, potentially significant uptrend is beginning for gold. When a golden cross occurs, traders might consider entering a long or buy position in gold futures, anticipating further price appreciation. Conversely, a bearish signal is generated by a death cross. This happens when the shorter-term moving average crosses below the longer-term moving average. Using the same example, if the 50-day SMA for gold crosses below the 200-day SMA, it is considered a death cross. This event is often seen as a strong indication that a new downtrend is starting, or that an existing uptrend has decisively ended. Traders might interpret a death cross as a signal to enter a short or sell position in gold futures, or to exit any existing long positions to protect profits. While moving average crossovers can be effective, it's important to be aware of their limitations. This strategy tends to work best when gold is in a clear, trending market, either consistently up or consistently down. In sideways or ranging markets where prices fluctuate without a clear direction, moving average crossovers can generate frequent false signals, leading to whipsaws and potential losses. Therefore, it is often wise to use this strategy in conjunction with other indicators or chart patterns to confirm signals. Always implement proper risk management, such as setting stop-loss orders, to protect your capital when trading gold. In Section 8, we look at Practical Strategy 2, using RSI for gold entry and exit points. The Relative Strength Index, or RSI, can be a valuable tool for identifying potential entry and exit points when trading gold futures, especially when used thoughtfully. As we discussed, the RSI measures momentum and highlights overbought, typically above 70, and oversold, typically below 30 conditions. A straightforward strategy involves using these levels as preliminary signals for action. However, it's crucial not to act solely on these levels, as gold can remain overbought in a strong uptrend or oversold in a powerful downtrend for extended periods, leading to premature entries or exits. For entering trades, a common approach is to look for the RSI to move out of these extreme zones. For example, a trader might consider a buy signal for gold when the RSI has been in the oversold territory, below 30, and then crosses back up above the 30 level. This suggests that selling pressure might be easing and buyers could be stepping in. Conversely, a sell or short sell signal might be considered when the RSI has been in the overbought zone above 70 and then crosses back down below the 70 level, indicating that buying momentum could be fading. For exiting existing trades, the RSI can also provide useful clues. If you are in a long gold position, and the RSI moves into the overbought territory, say above 70 or even 80, and then starts to turn down, it might be a signal to consider taking profits. This suggests the upward move may be losing steam. Similarly, if you are in a short gold position and the RSI drops into oversold territory, below 30 or 20, and then begins to turn up, it could be an opportune moment to cover your short position and lock in profits. RSI divergences can also serve as powerful exit signals. The reliability of RSI signals for gold trading can be significantly enhanced by considering the broader market trend. For instance, in a confirmed uptrend, perhaps identified by gold trading above its 200-day moving average, buy signals from the RSI like exiting oversold conditions or bullish divergences tend to be more reliable. Trying to sell short based solely on an overbought RSI reading in a strong uptrend can be risky. Similarly, in a clear downtrend, sell signals from the RSI like exiting overbought conditions or bearish divergences are generally more dependable. Context is key when using any indicator, including the RSI. In Section 9, we discuss navigating gold futures wisely, focusing on the benefits and risks of technical analysis. Utilizing technical analysis for trading gold futures offers numerous benefits, especially for traders seeking a structured and disciplined approach. It provides a framework for identifying potential trading opportunities based on historical price patterns and statistical indicators, rather than relying on gut feelings or subjective opinions. Technical tools like moving averages, RSI, and MACD can generate objective entry and exit signals, which can help in reducing emotional decision-making. Furthermore, technical analysis is instrumental in risk management, allowing traders to define logical stop-loss levels based on chart patterns or indicator readings, thereby helping to protect capital. Despite its many advantages, it is crucial to understand the potential risks and limitations associated with technical analysis in gold trading. No technical indicator or strategy is foolproof. They do not guarantee profits. Technical indicators are derived from past price data, which means they can sometimes lag, especially in fast-moving markets. This can lead to late entries or exits. False signals, often called whipsaws, can also occur, particularly when gold is trading in a sideways or choppy range rather than a clear trend. Remember, past performance of an indicator or pattern is not a definitive predictor of future results. Effective risk management is absolutely paramount when trading gold futures, primarily due to the leverage involved. Leverage can amplify both profits and losses, meaning a small adverse price movement can result in significant losses if not managed properly. Always use stop-loss orders to define your maximum acceptable loss on any single trade. Employ prudent position sizing. Never risk a large portion of your trading capital on one trade. A common rule of thumb is to risk no more than 1 to 2% of your account balance per trade. Most importantly, only trade with capital you can genuinely afford to lose. Finally, success in trading gold futures using technical analysis requires continuous learning, adaptation, and discipline. Financial markets, including gold, are dynamic and can change their behavior over time. Strategies that worked well in the past may need adjustment. It is highly recommended for beginners to practice on a demo trading account before committing real money. This allows you to test your understanding of technical indicators and strategies without financial risk. Consider combining technical analysis with a basic understanding of the fundamental factors that can influence gold prices. Observing gold's unique characteristics and market behavior will also refine your trading skills over time.